Welcome to the Pro Ticker Deep Dive. We are diving headfirst into a truly fascinating financial anomaly today, one that's really defining the streaming war landscape. We're looking at the two giants, Netflix and Disney.
Right, and we're trying to understand this dramatic valuation canyon that separates them as of, late 2025.
It's more than a canyon, it feels like a chasm, and it brings up a really fundamental question for investors, doesn't it?
It absolutely does. You have the longtime king, Netflix, which is sort of the poster child for growth and momentum, holding this incredibly high premium.
And then on the other side, you have Disney, a deeply diversified value behemoth that on the surface seems to be trading at a discount.
Exactly. So our mission today is to break down the financials, the shifting strategies, and, the macro headwinds to answer a simple question.
Is Netflix truly priced for perfection, and what happens if it stumbles?
Or is Disney being unfairly discounted despite, finally achieving that profitability in its streaming segment?
Let's start with the core data point because this really sets the stage. I'm talking about the PE ratio, the price to earnings.
It's dramatic. Right now, Netflix trades at a PE of 45.83. So if you buy Netflix stock, you're paying almost 46 times its annual earnings.
46 times. And then you look across the aisle at Disney, and you are paying just 15.28 times its earnings.
That's a threefold difference, nearly. It's massive. And it immediately signals this tension between investor types, right?
For sure. Those chasing that hypermomentum versus those who are looking for, classic fundamental value.
Okay, so why is that gap so stark? Let's unpack the core metrics. Netflix has a market cap of, $466 billion?
A huge number. And it reflects their undeniable scale. They have an unrivaled 302 million global subscribers.
Which just crushes Disney's combined base of 196 million. So when you look at pure reach, Netflix is the undisputed leader, no question.
And investors love a winner, right?
Sure.
Over the past year, Netflix stock has surged a massive 45%.
And their Q3 results were, they were a show of force. $11.51 billion in revenue and operating margins sitting at a very robust 28%.
So when we say Netflix is priced for perfection, this is what we mean. The market is assuming that 28% margin keeps expanding and that 45% growth is sustainable.
Right, regardless of what's happening in the broader economy. And that assumption, that's precisely the risk baked into that 45x PE ratio. The market leaves zero margin for error.
None. Now, let's look at Disney. It's the clear value play. Their stock gain over the last year was, it was a respectable 9%.
Respectable, but definitely underwhelming in comparison.
But the story inside the company is monumental. They did something critical. The direct-to-consumer or DTC segment is finally consistently profitable.
And that turnaround had been the promise for years. They finally delivered. They posted $352 million in operating income in Q4 alone, with their streaming margins expanding to 39%.
That margin expansion is so crucial. But here's the real differentiator, I think. Diversification.
Absolutely. While Netflix is a pure play, it lives and dies by streaming, Disney has this powerful safety net. Their theme parks generated a record $10 billion in operating income in 2025.
10 billion. That's steady cash flow. From parks, from cruise lines, from content licensing. It's a huge financial ballast.
A ballast that Netflix simply does not have if streaming growth starts to slow down.
So Netflix is running a marathon on a high wire while Disney has this empire giving it a margin of safety. And this becomes even more important when you look at the whole streaming landscape. It's shifted.
It's no longer the gold rush of 2020. That chaotic, land grab phase is over. It's done.
We've seen major companies like Warner Bros., Discovery, and Paramount basically admit that this is a 2- or 3-horse race now.
Consolidation is set in. The era of just acquiring customers at any cost is finished.
But here's an insight that I think gets overlooked when we talk about the streaming wars. The biggest threat isn't another media giant.
No, it's YouTube.
Exactly. Nielsen data from mid-2025 is striking. YouTube captured 12.5% of all U.S. television viewing time.
And Netflix.
Netflix is way behind at 7.5%. Disney's combined properties are at just 5%.
And this is where we need to stop thinking about revenue just in terms of paid subscribers. YouTube's model is free, it's ad-supported, and it generates an astonishing $54 billion a year.
$54 billion. Compare that to Netflix's $39 billion.
It proves that monetization is just. It's way more complex than just who has the most paid users. The scale of ad-supported content is changing the economics of the whole industry.
And you add in the broader economy, right? These elevated interest rates make Growth stocks like Netflix more expensive to own.
It fuels that rotation. Investors start looking for value, for dividends, for diversified revenue, all of which favors Disney and puts pressure on Netflix's premium.
And we haven't even mentioned the content arms race. They're both spending a fortune.
An absolute fortune. Netflix spent $18 billion on content in 2025. Disney is deploying an even bigger $24 billion for its 2026 slate.
And when a top-tier show costs, what, $15 to $20 million an episode?
Yeah, that creates this structural margin pressure that eventually even a company trading at 45 times earnings cannot ignore forever.
Which brings us to how they're adapting their strategies. The whole narrative around subscriber counts is changing.
It has to. I mean, Netflix finished 2025 with 302 million members, which is great, but they've deliberately shifted their communication away from that number.
They're focusing on revenue now, average revenue per user.
Exactly. They're signaling to the market that the growth at all costs era is over. Now it's about disciplined monetization.
Disney, on the other hand, is leaning hard into its bundling superpower.
For sure. With 196 million subscribers across Disney+, Hulu, and ESPN+, the strategy is all about making those users incredibly sticky.
And here's a perfect example of that. 80% of new ESPN app subscribers chose the Trio bundle.
That's the Disney+, Hulu, and ESPN bundle for $35.99 a month. That kind of deep integration creates really high switching costs for a customer.
The next battleground is the ad tier. And Netflix is showing some serious muscle here.
They really are. Their ad-supported tier hit 190 million monthly active viewers globally by November. In the U.S. alone, it's now in 45% of households.
And that ad revenue is projected to double in 2025 to about $2.9 billion.
That's the second engine they desperately need to justify that high valuation.
But Disney is playing the distribution game really shrewdly, too. They're using partnerships.
Like the Charter Communications deal, including Hulu and the Spectrum Select bundle, added 8.6 million subscribers almost overnight.
It just shows the power of teaming up with traditional distributors instead of only fighting them.
And this all leads to the valuation reckoning. When analysts use discounted cash flow models, a lot of them suggest Netflix is overvalued right now.
By how much?
By about 27%. Its fair value might be closer to $86 a share, but it's trading around $110 post-split. That's a significant overhang.
Which makes that cushion Disney offers at its 15 PE look even more attractive.
Right. If streaming slows, Disney can lean on its other businesses. You're seeing huge international growth at the parks. Disneyland Paris revenue surged 25%.
They have levers to pull that go beyond streaming. Netflix really only has streaming and now live events.
Okay, so let's drill down into the bull and bear cases for both. Why are investors still so optimistic about Netflix?
Well, the bull case is built on 3 pillars: scale, proven content, and disruption.
That unmatched global reach is the foundation. And yes, they spent $18 billion in 2025, but that spend fuels guaranteed hits. We're talking major returning franchises like Stranger Things, Wednesday, Squid Game.
These are proven engines for keeping people and signing up new ones. But the really disruptive part, the thing that could justify that multiple, is live sports.
Absolutely. We saw the NFL Christmas Game Day in 2024 get over 26.5 million viewers in the U.S.
And the $5 billion WWE deal for Monday Night Raw is pulling in 3 million viewers an episode.
And you can't forget the Jake Paul versus Mike Tyson fight. It peaked at 60 million concurrent streams globally. And here's the key. It was offered without a pay-per-view fee.
Which completely shatters the legacy model. For bulls, this is proof that Netflix isn't just a streaming service anymore. It's evolving into a new kind of global cable bundle.
But the bear case is just as potent. Content spending is that elephant in the room. The CFO confirmed that $18 billion is not anywhere near a ceiling.
So as long as they keep raising the bar, margins are under constant, brutal pressure.
And then there's that engagement gap we talked about. YouTube just dominates attention. In the first half of 2025, YouTube had 835 billion viewing hours. Netflix had 95 billion.
That's a nearly 9-to-1 difference. That's a huge competitive risk.
It really is. And when you're trading at 45 times earnings, you're expected to be technically perfect. We've heard about glitches during live events, like that Paul Tyson fight.
Any big execution flaw can instantly damage brand trust and cause that multiple to compress.
Okay, let's flip to the Disney bull case. It's built on profitability and defensible IP. The record park profits are the centerpiece. $10 billion in operating income for fiscal 2025.
That's pure, stable cash flow. And the DTC turnaround is real. It posted $1.3 billion in operating profit, which is an amazing recovery from burning $4 billion a year just a couple years ago.
And they own the content library that Netflix can only dream of. Marvel, Star Wars, Pixar. That IP is unreplicable.
Plus, they're collaborating brilliantly. That new bundling partnership with Warner Bros. Discovery's Max is a perfect example.
But Disney faces powerful headwinds, too. The bear case starts with that collapsing legacy business. The linear TV division, their old cash cow saw revenues dropped 16% in Q4.
That legacy decline is offsetting some of the streaming gains.
And while DTC is profitable, that $352 million in Q4 operating income is, well, it's fragile compared to Netflix's $3.25 billion in Q3.
So they have very little room for error while managing that massive $24 billion content spend.
Finally, there's the technical risk. They're trying to merge Disney Plus, Hulu, and ESPN into one app. That's hugely complex. If it's clunky or slow, they could alienate users.
Which brings us to the final investor decision, the trade-off between momentum and safety.
Netflix is the momentum choice, up 45%, but it comes with higher volatility, around 4.61%. So you're going to see bigger price swings.
And Disney is the consolidation play, up 9%, with about half the volatility at 2.44%. So for you, the investor, the question is, which risk-reward scenario is better?
Well, given the PE difference, Disney seems to offer the better risk-reward profile right now. At 15 times earnings, there's potential for multiple expansion. If the market decides it deserves a sector average PE of, say, 20 to 25x.
That could yield a 30 to 60% upside, even if earnings growth is just modest.
Exactly. Whereas Netflix, at 45x, has limited upside and a lot of downside risk if they fail to maintain that perfect execution growth rate.
And there's one other thing for income investors. Disney pays a dividend. It's about 0.96%. It's a small but powerful sweetener that Netflix doesn't offer.
So to synthesize this whole deep dive, that threefold PE difference is the definitive story of the streaming wars in late 2025. Netflix has to keep executing perfectly to defend its premium.
While Disney offers a margin of safety, that immense diversification, and the potential for its multiple to expand as streaming matures, the battle isn't about who can spend the most anymore.
No, it's about who has the most sustainable and sensibly priced business model. And I would expect that valuation gap to narrow over the next 12 to 24 months. Capital's moving toward value over pure momentum.
See you all in the next Pro Ticker Deep Dive.